All right, candle range theory trader back with you with another video on a deep study of the daily expansion candle. So let's get right into it. Our focus is going to be candle 3, sometimes candle 4 of the candle range theory, but ultimately we're trading when the range candle and manipulation candle has already taken place. Our focus is just one candle. Okay, as well. Sometimes we'll have a continuation trade whereby you'll have candles 1, 2, and 3. If candle 3 closes below candle 2, then the next day, sometimes there will be a continuation. So we'll also look at some of these examples as well. And as well, this is a 2 candle range theory pattern whereby you'll have candle 1. And then what candle 2 will do in this case is both manipulate and expand and close below the low or high in a long example of the candle range. And then we're going to focus on this candle right here. Okay, so all of these examples, we're still only trading one daily candle, but these are in essence all of the examples that we're going to be looking for. These are our patterns. So a special note on the continuation trade though, you need to be most ruthless on continuation trades because while they can happen, they are less likely. Okay, if anything looks wrong or out of place when you're trying to get a continuation, cut the trade. Okay. Now, you have to program your mind to know how an expansion candle acts. Okay. They don't all exactly act the exact same way every single day, but many of them have certain non negotiable similarities. Let's put it like that. Okay. Because that candle has a wick, a body, and then a wick. Sometimes it has no wicks at all. Okay. But it should spend the majority of the day moving in your direction if you're right. Now, when you're trading candle 3 of the daily candle, you need to pick a hard cutoff time to stop trading. Why do I say that? Because, as I said, the majority of the day should be price expanding in your behavior. You have a window to enter, and then after that, you're just sitting back and watching the profits roll in. That's how it's supposed to go when you're right. So, with candle 3, I recommend stop trading at either 1 a.m. Eastern Standard Time, 5 a.m. Eastern Standard Time. The latest, absolute latest, I would do is like 8 a.m. Eastern Standard Time. Maybe 8:30 when there's news. It just depends. But ultimately, you need to have a time to say, okay, you know what? The trade's probably not going to work out for the day, and that's fine. Uh, Candle 4 for the continuation. I recommend 1 to 5. I wouldn't take any moves after 5 because you're expecting a straight drop. And as well, oftentimes with the continuation, it'll end on a wick. So you have to watch for either a reversal, even in New York, or sometimes even London. If Asia gives the straight drop, sometimes London will go ahead and start to retrace. So you never know, either one of those. So the wick of the daily candle, because this is a daily candle, the wick can be up to 50 pips on higher average daily range pairs. Sometimes you have a smaller wick, but it really should depend on where the manipulation candle closes. Okay. So the farther away the manipulation candle closes for the range, typically the longer the wick can be. And as always, if you want to use fair value gaps on the daily chart, that can give you better odds for a large move, but I'll show you that in some upcoming slides. Now, the number one indication to me of a true expansion candle is respect of fair value gaps on a smaller time frame, be you trading a 5-minute or 15-minute chart. Typically, when a fair value gap gets created, price retraces into the gap and it expands away, or it never just retraces it at all. It just keeps going. It keeps going. It's a unidirectional move. That's what you're really expecting when you're trading the expansion candle. If it doesn't do that, or if it starts to chop around, it's a sign that that may not be a true expansion candle for the day. All right. So price should always be willing to move in the same direction. So as you're studying these expansion candles, you need to ask yourself some questions. What are the best times to get into the trade? What are the best times to get out of the trade unless you set a hard stop loss? When should you consider this to no longer be an expansion candle? When is it too late to trade? Where does the manipulation candle on the daily chart end? Okay, where does it tend to close at? What's the best kind of manipulation close to see? Are there any commonalities in the absolute best trades? Does price tend to consolidate often when you're trying to trade this model? Are there any key price moves like fair value gaps or swing highs and swing lows? How long are the wicks on an expansion candle? Is there a max wick length that I should look out for? So say if I'm expecting price to have like a 20 pip wick and it wicks 100 pips, is that like a red flag? You need to know these things. You need to know what's out of the ordinary. Okay, and how do I know when the expansion candle is not likely to be a true expansion? So you have to know that and filter out the bad trades. So let's look at some examples here. All of these will be start on the daily chart and then drop down to the 5-minute. Okay, I trade the 5-minute chart. So like I said, bigger time frames are daily. So we have a 3 candle pattern, very simple candle range theory. Thursday gives us the range, Friday is the manipulation. which we do not trade. We do not trade candle 2. I know some people try that. I would not recommend that. Candle 3 gives us the expansion, which in this case was a Monday. Now notice though how this middle candle closed pretty close to the low of Thursday. That's what we like to see. Okay, we like to see close closes. Now here is Monday. Okay, this large candle right here, this large green candle, is this on the 5-minute time frame. Now this vertical line here is a 5 a.m. cutoff to just say, hey, you know what? I'm going to be done at 5, whether I see my trade or not. But actually, in this case, the best entry was at 8 p.m. the prior day or prior night. Okay, you could have caught this trade during close to Asian session. Where it was right here, it was pretty much just a straight rise. It didn't really have much of a wick at all. Just boom, fair value gaps here. Remember I talked about how fair value gaps tend to hold, and then it just went straight up. So you could have got in at 8 p.m. and you would have exited by 11 a.m. the following day. It would have been an overnight hold. And as you can see, price just went up. It retraced a little bit. You might have got a little nervous here. But ultimately, the price then did continue to create more fair value gaps. And notice how the reaction off of the fair value gaps, when it hits the gap and rockets up, that is a great sign. Anytime it hits a gap in your favor and rockets up, that's a great sign. See how here it hits the gap, rockets up. That's the behavior that we're looking for. If it starts to take out these gaps and take out these gaps, and there were gaps here, like this used to be a gap that did get taken out, but however, these were still holding, right? So you want to look out for that type of stuff. So this was a 2-candle CRT. So we have the range candle. Well, I didn't isolate the days, but let's just say this was on Monday, Tuesday, and this is Wednesday. Now, here's the thing. This whereas the case where a price manipulated and expanded all in the same day and closed above the candle. So we're looking for a continuation. But because price closed all the way up here, when it comes to a continuation, we're not looking for price to go all a straight line up, right? This has a very long wick, and considering how it closed in relation to candle 1, the range candle here, what did price decide to do? When it opened, it went all the way back down before retracing coming back up. So this candle used to be solid red. All right. So, and as well, but one of the best things we like to see, if candle 2 dips into a daily fair value gap and then closes above it, that can be a great sign that a large move could be coming. So that's what happened. So let's take a look at the 5-minute chart. Now this was a 54 pip wick. Now, why do we allow for that? Because of where it closed. Sorry, wrong chart. Okay. Because it closed all the way up here, we have to make an allowance for this to happen. That's why. Okay. We don't just expect for price to just break out of the range and keep going. Okay. So when it comes to the wick, it opened, went down. Our best entry was around 11:25 p.m. If you have a long bias and then you check the chart, say around 10 or 11 p.m. Eastern Standard Time at night, when you see it's down like 54 pips, the main key to taking this was that it tapped. Look at this green line right here. That's the low of the range. You could have got a very ideal entry right here and then a second chance right here. But remember our cutoff time, okay, about 5, price should be moving in your direction by 5 at the latest. Okay, if it doesn't, something may be wrong. But there was a clean entry here, another chance right here. And notice how it rockets off of these fair value gaps, creates more fair value gaps here, comes up some, retraces, and then keeps right on going. So this was good for 110 pip rise all the way to the end of the day. Okay, so that would have been an awesome trade. Okay, let's take a look at a couple more. So this was another long example here. So you have the range candle on Thursday, Friday the elimination. We're not trading that. Now, so notice the close. The close is all the way up here. So we have to make allowance for the wick. Okay, again, price does not move in a straight line. If it closes all the way up here, then we have to be patient to see how far is price going to go down before it starts to come back up. So Monday and Tuesday were the expansion and continuation candles where we had 2 opportunities. So let's take a look at Monday first. So this price action right here on the 5-minute is this green candle right here. This is our trading day. So we see the wick. Let's take a look to see what our best entry was. So we see price opened, went down, and created a first fair value gap. The first fair value gap is going to be one of the most important. How does price react off the first gap? Okay, off the low of the day. And it was this for example, a 1 a.m. cutoff. So let's say I stopped trading at 1. The best entry would have been around 9:25 p.m. to 10:30 p.m. Plenty of time because price consolidated right here near the gap before taking off. And this was a 95 pip rise. It broke out of the range all the way. Your exit would have been about 10:50 a.m. Right? So this would have been like from 10:30 p.m. to 10:50 a.m. Okay, that's a very long hold, but as you can see, it was pretty much a straight rise to profit, right? So there you go. Now let's take a look at Tuesday. So this chart right here, okay, if you need to pause it, so be it. But this chart right here is this candle right here. Okay, this chart, this candle right here is this chart right here. Now this one didn't have much of a wick at all. Best entry would have been around 1 a.m. Here's the first fair value gap. That's always, like this. Just make a note of that. The first fair value gap off the low of the day or high of the day if you're short. Most important gap to see. If that holds, hey, you might be in for a good day. No, nothing's guaranteed. It's just that's a good sign. So this one gave you plenty of time to get in from 9:35 p.m. to 11:10 p.m. Eastern Standard. Entry window could have been just a fair value gap off the low of the day. You see here, price just exploded out of it. So anytime you see a price just explode out of the gap, that's a good sign. It will retrace, but at the end of the day, the price went up 100 pips. Your exit would have been at 10:55 a.m. Again, another long hold. You would have held it overnight, but all that could have been yours. So there you go. So this was another 3-candle pattern. We have Monday range, Tuesday manipulation, and then Wednesday the expansion. Notice again here, notice the close. The close is all the way up here. We have some distance between the range low and the close. So what does the wick do? It opens and touches the bottom. Anytime it touches the bottom of the range, that could be a great sign to go ahead and get in. It did do so here and rocketed up right here. This was on GJ. So there was a 60, this wick though was 61 pips because news did come out. The entry would not have been until, I think the news on this one, because this trade just played out this week past. The news, I think, was at 2:30 a.m. So news just spiked down. Then you see railroad tracks off the bottom. There is no fair value gap here. I know that. However, there is you could say I didn't isolate it here, but there is a change in the state of delivery on this line right here. And the low held as well. So, anywhere you could have got in here would have been fine. 3:10 a.m. was the best entry, and then it was pretty much just a straight rise to profit. The first fair value gap didn't appear until all the way over here. But even if you wanted to use that could have been fine. The stop loss may have been a little, open to interpretation. But as long as the gap would have held, that's fine. But if you just want, when you trade these, if you just want to try to focus on, I'll just take the first fair value gap. I'm not going to worry about the low of the day. But I'll know once I see the first fair value gap that holds and the price retracing to it, I'll just try to do that. If you want to keep it simple, feel free. It's just, again, stop losses. You're going to have to leave that open for interpretation. Mainly, you're hoping that the gap holds. That's the main thing. But if you just want to do fair value gaps, that is more than fine trading this method. So here's some short examples now. So here's a one with a continuation where you have a Tuesday range, this green candle here. Wednesday gave the manipulation. We're not trading that day. This is Thursday. So we see because price traded closed all the way down here. Look at this large gap between Tuesday's range high and a close on Wednesday. So Thursday we have to make allowance for a possible wick or a retrace, and that did happen. So this is Thursday. So Thursday had a 36 pip wick. Okay, so this is the daily open. This line right here. Price did go down. You may have gotten stopped out if you tried to go ahead and just take the trade early because price came all the way back up and then eventually went down. So this is one of those where you would have had to wait. This was an 8 a.m. cutoff because this probably would have stopped you out. But if price does this, don't give up on the trade. Now, I don't know if this was news related or not in terms of the severe drop, but the only time you should really be concerned is if price breaks out of the range high. If it does that, then it's like, okay, I might be wrong for the day. All right. But as long as price stays below the range high, it's a valid short bias. Okay. And now just to reiterate for longs, as long as price stays above the range low, if you're long, it can tap it. But if it doesn't break it, keep the bias. Don't give up on it. Okay. So in this case here, it didn't even touch the range. It didn't even come close. It did just retrace a little bit, but it didn't touch the high of Tuesday. It really didn't. All right. So this just, manipulated some folks long, but eventually it did tank. So the best entry here would have been at 8 a.m. And then it did drop for 100 pips. You would have got in at about 7:05. At 7:05, actually, AM was the best entry. First fair value gap was right here that held. And then 100 pip drop, 10 a.m. would have been the best exit because price spent the rest of the day consolidating. So that's that. This was the Friday continuation. So this chart right here is this day right here. Okay, because this candle 3 closed below candle 2. So we try to see if we can catch a continuation. These I do not anticipate large wicks. Can they happen? Yes, depending on where it closes. I understand all that. But at the same time, if I'm expecting continuation, especially if here's another thing to keep in mind. If this candle has a fairly large wick here, see how it retraced, then the smaller this wick should be right here. Okay. So it shouldn't retrace that much because the retrace already happened. Now, so yeah, let's just focus on that. All right. So here's Thursday here. Friday here. We only had a 6 pip wick. Okay. Slightly above the daily open. Here's the first fair value gap right here. Price retraced back into it. Your best entry would have been around, what is this, 2 a.m.? And this was good for an 80 pip drop. So as you can see, fair value gaps, these don't even get revisited. This one here just holds and stays, holds and stays. This one almost got back to it, but see when it gets to the gap and it just rockets down, that's the behavior consistent with a expansion candle, okay? Because it's just creating this body right here. That's all it's doing on a smaller time frame. Okay, so let's keep going. Another one, here's a Friday range candle, which is this doji right here. We have a Monday manipulation candle. Not the best one because it closed right at the range, but then Tuesday give the expansion to the upside. So remember, if it closes near the range high, then this one here was just a brief solicitation to go long, and then it dropped like a rock. Okay, so daily closes are very important. So let's take a look, see what happened. The best entry would have been between 8:05 and 8:40 p.m. Eastern Standard Time during Asian session. Here's the first fair value gap right there, but we want to trade inside the range typically. Okay, so as long as this fair value gap here that was created on the range holds, I will take that as a good sign. So you did get a second chance between 2:35 and 3:05 a.m. And this was a 92 pip drop until 9 a.m. Okay, it just sank, right? Broke out of the range, came back in the range, and then broke down again. All right, so, but all that could have been yours just trading like that. Okay, this happened during Asia. Here's another example here where we didn't exactly close out the range, but this was still some good price action where we have the range candle on Thursday, Friday, and then Monday. Notice how price closed fairly close to the range. It only closed 15 pips away from the high. So that's pretty good. So we'll make a slight allowance for a wick. But again, price should stay below the range. You can tap it, but should stay inside of it. Okay, so best entry here would have been real early at 6:30 p.m. Okay, it just was what it was. That's when it happened. Okay. And the best exit would have been at 2:20 a.m. because sometimes the earlier you enter, the earlier you may need to exit because price can reverse during London session or New York session, or just consolidate. In this case, it pretty much just consolidated. Not much happened here. Anybody who tried to went long, they may have got a little bit of price action, but the shorts were the winner for this day. Okay, so there you go. 99 pips, done deal, easy. Here's a 2-candle CRT, whereby we have Monday the range, the manipulation, and expansion came all in one day. Price closed below the range is low. So remember, when we see a longer wick for this close, we should see a shorter wick for the continuation. We don't expect price to go all the way up here. Okay, here was the retrace right here. So the next day should have a softer retrace and then a bigger drop. Okay, so price closed 40 pips outside of the range. So now for this expansion candle, this is our trading day right here. I do not trade these models. I don't trade this. I only trade this when it comes to the 2 candle. I used to try, but it's not for me. Okay, so I like continuations if I take these 2-candle setups. So here it is. It's only a 7-pip wick. The best entry was between 8:55 and 9:15 p.m. Okay, the night before. The best exit would have been 2:35 p.m. the next day. So this would have been a real long hold. I don't know if there was news this afternoon or not, but it did come and it just dropped like a rock. So this would have been 100. This was a 130 pip drop, but as you can see, price then swiftly retraced. And so this wick right here is this price action right here. Just retrace the rest of the day after this sharp drop. If you see a big drop like this was one of your main signs to go ahead and just get on out. Okay, because prices, they can only go down so far, but before it's going to retrace. Okay, but this would have been an excellent trade. Now let's take a lesson from a loser, because obviously you may have a candle range theory you think is going to play out, but it doesn't. So how do we recognize a loser? Because the first 2 candles, like I say, they look good. Let's take a look at this candle right here that did not play out red. All right, let's take a look. Now, what I did here, I know this looks kind of confusing, but what I did in this case, I wanted to show you every single fair value gap, because how I have my indicator set up for the fair value gaps is that when the gap gets filled, it disappears. But notice all these gaps that got created and then got filled. Now, remember the behavior of an expansion candle. We expect fair value gaps to hold and not get filled if we're right. Okay, so this would have been a short bias. So let's just say if we took this trade off of first fair value gap right here at 9:20 p.m., we did get some good price action to the downside, a little bit of a retrace, and then went down here. This vertical line is our 5 a.m. cutoff. Now, let's take a look to see which fair value gaps actually survived. This is the same chart, but now with the fair value gaps that held when the day closed. And look at that. Okay. Bullish fair value gap, that's a red flag. The main first red flag though here was the change in state of delivery. If you don't know what change in state of delivery, to put it simply, whatever price action created the low, which in this case, I think I may have moved the line down a little too far, but really it's this line right here. But off the low of the day, when price closed above this level and this low holds, that's a red flag. The second red flag though would have been this fair value gap right here holding and then rocketing out and then coming down and then rocketing out again. If nothing else, your main sign to get out would have been the price reaction off of this fair value gap right here, which was after 5 a.m. But if you're just monitoring the trade and you happen to notice, okay, there's a fair value gap. Okay, well, let's see how price reacts. When you see price shoot up like that out of a gap and then create another one, either you should be at break even or you want to go ahead and take what little profit you have, because if you held, this would have been a loss. Now, it doesn't have to be a big loss, but when it comes to losses, they should be small or break evens. Okay, now compare this price action though to a winner. All right, look at this one. Fair value gaps held. Some of them did not even get revisited. There was a false low of the day here, but then notice how price came up and then it went right back down. So even if someone thought this was the low of the day, no, it got taken out very quickly. Okay? Got taken out very quickly. So you have to compare that. They're all fair value. The fair value gaps held. There was no violent reaction, no change in state of delivery after the 5 a.m. cutoff. So after 5, like I said, that's your profit-taking time where price should be moving your direction. If you see something like this after 5 where price is steadily moving against you, okay, after 5 a.m., okay, notice that after 5 a.m., if price is going against you, red flag. Winners, after 5 a.m., I'd say at the latest. Well, 8 a.m. at the latest, but I say typically 5. 8 is a rarity. But typically 5, price should be steadily moving in your favor. Okay? Not doing this. If it's doing this, again, red flag. Okay? So, some notes on the behavior real quick. Trading can start as early as 8 p.m. It's unlikely you'll hold trades past 11 a.m. of the next day. If you trade the night before, look to be out by around 10, 11. Unless you get in really early, like say 6, 7 p.m., then you might have to get out by London. But, if you want to set an alert, I don't want you to watch the chart 24/7, but just know what to look for and just know what a red flag looks like. The earlier you take a trade, the earlier you may exit. So remember that the Asian session happens and then London may undo it, or London session happens and then New York session may undo it or retrace. The best manipulation candles, remember, they do close near the candle range theory high or the candle range theory low, about 20 pips or less from the range. You don't want to see, it's not ideal to see a candle range theory candle close like 100 pips away from the range high. That's that leaves too big of a window to me. I like tight closes near the ranges. Small wicks are best, but make allowances for big wicks depending on where the candle closes, especially if the manipulation candle closes away from the higher low, as I said earlier. Okay. So the narrative that you have to tell yourself before taking a trade is this. Like when you come to the chart, this has to be your mindset. Okay, I have to see my setup between the daily candles open and 5 a.m. Eastern Standard Time. I'm going to stop trading at 5 a.m., for example. I'm going to look for a fair value gaps, the first fair value gap to enter off of, or a change in the state of delivery. Once I'm in, price should respect all the established fair value gaps. That's my confirmation. And it should also establish new fair value gaps in my favor. If I see a change in state of delivery in the opposite direction, or I'd also add if price goes against me after 5 a.m., I may need to set my stop loss to break even, monitor the trade, or just take whatever profit I can get and just look for the next setup. I expect to exit around 11 a.m. or so, or if my TP gets hit sooner than that. And that's it. That's what you have to tell yourself. Here's a little bit of a different perspective as well, if it helps, because remember that each daily candle is made up of 3 8-hour candles, 6 4-hour candles, and 24 1-hour candles. So I wanted to show you this distribution candle on pound yen, and I'm going to show you this big red candle across the 3 time frames. So this red candle looks like this on the 8-hour chart. Is this helpful to you at all? If so, hey, maybe experiment with that. This is the 4-hour chart. Okay, just broken down. 1, 2, 3, 4, 5, 6. This is that large red candle I just showed you, just broken down. Is this of any help to you? What do you see about this? What do you notice about this? Does any of this, does any of this resonate with you? This is a 1-hour chart, and I included the fair value gaps with this. Um, does this help you out in any way? Okay, these are 24 candles. This is still the same thing, just broken down over this time frame. And look at the gaps. So notice how it reacted off the 1-hour gap right there at the low. Here's the first 1-hour gap here at the high. I mean, maybe there's something there. Maybe you want to experiment with that. Okay, it's up to you. But in conclusion, attention to detail is going to be key when you're studying this. You're going to look for those. Don't try to make 1,000 different notes. You don't have to know how price moves tick by tick, but you should see very similar behaviors every single time that you do trade an expansion candle on the daily time frame. Okay, be scientific in your approach. Play with time frames. You don't have to do exactly what I do. Toy with the 1 hour, the 30-minute. Go down to the 1 minute if you want. I don't care. Okay, remember the best daily closes are near CRT highs and CRT lows. If you know the behavior, you'll keep your losses small because you'll know when something isn't right. That's the main thing. You need to know, hey, this is moving right, or hey, I think something's wrong. Okay, you have to know the behavior. Okay, the rules that are put in place are there to protect you, not to restrict you. And I know sometimes it sucks when you think you have a setup and it doesn't play out by 1 a.m. or it doesn't play out by 5 a.m. and you think you want to give it a little more time. But there could be a doji forming. Okay, or maybe sometimes the price isn't going to do anything, and I'll show you that just to wrap this video up in a second. But you can be a CRT expansion candle expert if you're willing to put the time in. You can do it, but remember the chart is going to show you more than I ever could. So real quick, I'll show you a brief example on a trade that I took today that didn't do what I wanted it to do. It was Aussie Swiss on the daily. Okay, this was the high. This was what was this, Wednesday, Thursday, and then today is Friday. Now, number one, too, as well. The Swiss pairs aren't the best pairs for. They're not the most volatile. They have a low average daily range. Okay, but notice here how price didn't move that much, right? It was still a decent trade, but it only went up 7 pips from the open, right, in almost 24 hours. That is not good to me, at least. I look for more price action than that. But does that mean that the range is bad or something was wrong with my analysis? No, it just didn't move as much as I wanted to. And that's okay. You have to just and you kind of see that and know the pair. And sometimes, to me, sometimes Swiss aren't worth trading. But I don't want to make this video too long. So the point is that you want to be sure that you are just simply studying the behavior and you know what to look for when you see these patterns, because if you don't put that time in, you're just going to take whatever looks good, feels good, and just lose money in the process. So look for the patterns. It's the same simple, repeatable pattern over and over and over again. Okay, over and over and over again. Here's a simple CRT right here. I think I already showed this to you. But in terms of finding them on the live chart, it's just as simple as you see the low, the high, and we wished every candle went up 100 pips, but they don't. I wanted to show you that as well, to know that not every candle does. And sometimes as well with continuations, I'll end with this. Sometimes the continuation won't happen on the third candle. It'll happen on the fourth. See, so this was, one candle here, went up a little bit here, but then expanded here. And there was news on the yen last night and today, so that's why I really did that. But had you held, or if you wanted to if you would have got long on this expansion candle here and possibly held overnight, and I'm not recommending that, it's just that, hey, you never know. But I promise you, somebody went short here. In fact, I think I did go short here and lost. Somebody might have framed that as a range. And you need to know that, hey, look, something's wrong here. If price is doing this, that's how you know something's off, right? It went straight up. All the yens did. But this looks like a candle range theory low. Look at that. Range, manipulation. Doesn't that look like the first two of this, or the first two of this, or the first two of this? See, it's the same thing. Sweep above, close inside the range. I got a short bias, but look what happened instead. It went up 202 pips. So let's turn this into an example, and then I'm going to be done, because learning from losers is just as important as learning from winners. What was our red flag here? Let's put the fair value gaps here too. Let's say we had a 5 a.m. cutoff. Get rid of the weekly open. Okay, here's the daily open. Here's the, wait, no, wrong one. Daily, okay, good, it's there. All right, here we go. And then we're going to put our lineup. Let's say we had a deadline of, let's say 5 a.m. Well, no, you know what? Let's do 1 a.m. We wanted to go short by 1 a.m. So scratch all of that. Here we go. Does this look like it's going short anytime soon? And see how it's breaking out of the range? If for no other reason, yeah, you may have gone short right here for a small loss. But if you see something like this, forget about it. And I'm not sure. I think that may have been when the news came out. I don't know. But if price breaks out of the range like that, just count on it not coming back, as you can clearly see. Okay. So this just would have just, you're going to be wrong sometimes. It's okay. So appreciate you watching. Take care.